My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramer. I'll be able to make friends. I'm just trying to make a little money. My job, not just to entertain you, but to educate, to teach. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Wall Street's endless confidence in the People's Republic of China never seems to stop. No matter how disappointing the growth numbers we see out of the Chinese economy, and they are plenty disappointing, people keep wanting to buy American stocks that are seen as having major Chinese exposure. And that includes days like today, where the Dow gained 210 points, S&P advanced 0.24%, NASDAQ edged up 0.18%. For decades, China did have a tremendous, scorching economy. That hasn't been true for some time. The idea of buying any stock because of its Chinese exposure is downright moronic. Because China's doing terribly right now. It's got the exact opposite problem for our country, an economy that's slowing to the point where you have to start wondering if they're sinking into a serious recession. China's got deflationary data, too, which can quickly spiral into a psychology of ever lower prices and wages. Deflation can be disastrous. Worse, China's got a 5.2% unemployment rate, with youth unemployment at an incredible 20.8%. And, hey, come on, man. Those are the official regime-approved numbers. You don't get 21% youth unemployment in a growth economy, but we still have muscle memory in our investment, right around here, all around here. Muscle memory telling us that the Chinese market is the best in the world. So any company with a connection to it will always blow away the numbers. We've had a parade of American officials going to see China lately, culminating in a 4-day trip by Treasury Secretary Janet Yellen, one that she says was constructive. They're always constructive. She met with high-level Chinese officials who agreed to more cooperation. They always agree to more cooperation. We're told the earnest dialogue will continue. There are always promises of earnest dialogue. The truth is, though, for years our country was the one that wanted constructive dialogue and positive engagement. China was the locomotive of global growth. All aboard! And we needed a piece of it. Lately, I feel like the situation is reversed. China now needs a better relationship with us than we need them. The Communist Party has endlessly tried to stimulate their economy, failing repeatedly, in part because all the stimulus seems to be related to real estate, which is never going to be a growth industry in a country with no growth in its population. All that said, American investors simply won't give up. They just have to have something that stands inside the thesis that China remains the promised land for anyone nimble enough to sell into their economy, even as their economy is falling apart. Now, discussions with Chinese growth always start with Apple, which has a strong franchise there, but Apple's losing a big chunk of its weighting in the NASDAQ 100. We just learned about this, along with some of the rest of the Magnificent Seven, which caused sellers to flee from this one. They want to get out ahead of the re-weighting on the 24th. It happened to all the stocks. Don't worry about it. But when you look deeper, you can see this trade still playing out. Let me go down the list of usual suspects. This angers me so much. I need you to focus. First, it's Caterpillar, right? Now, long ago, Caterpillar decided it had to diversify away from China. Too often, the business would swing with the vicissitudes of the Chinese economy, not ours. That is no longer the case, people. There are so many other important markets like the U.S. oil market, the U.S. infrastructure market, the U.S. data center market, and the minerals markets worldwide. As we see more and more federal infrastructure money flow from the states to the road builders, you better believe Caterpillar is going to get a flood of orders. And look, even though it's much less China-oriented than it used to be, when people think our relationship with the Chinese government has improved, they always buy the stock in Caterpillar. Hey, we took the unthinkable stance of actually letting a little Caterpillar stock go today for the trust, something we'll talk about when we have our investing confab on Wednesday at noon. Cat's a terrific story, but it's not a China story. And I'm afraid the 3-point gain and a few points that are leading up to it may not hold. Hey, how about Starbucks, another stock that's rallied 3 points today? Starbucks has a definitive plan to grow in China. They're putting up new locations here every 9 hours. There are already more than 6,200 Starbucks in China, with a plan to get to 9,000 by 2025 versus 16,000 in the U.S. But when you hear that our government's relationship with China could be on an even keel, well, the stock gets bought. Given that Starbucks sold off hard when things seemed rocky, I understand why it jumped today. But I say this. Give me a break. Last week I covered the sad saga that is Nike, which seems to have lost its way as it's doing a huge amount of business but not making a lot of money from it, which is what I care about. China's on fire for Nike, okay? They're not seeing any slowdown whatsoever, despite the high price points for many of their products. But China only makes up 14% of Nike's business versus 42% for North America, 26% for the Europe, Middle East, and Africa region. The idea that Nike's a China stock is a ridiculous pipe dream. Still, I get it. Nike's partnered with China's Ministry of Education to improve the health of several million kids. But unless the government decides to buy everyone a pair of Nikes as a way to stimulate the economy, you're making a big mistake if you buy Nike because of diplomacy. Now, there's one stock that can always be counted on reliably to fulfill the role of a hack China play, and that's Wynn Resorts. Hey, Trust owns it, casino company, 75% Macau, even as good business in Vegas and Boston, too. And that's why Wynn stock rallied almost 6 points today. I think people are looking at pre-COVID numbers with Wynn because Vegas and Boston are growing now, and the Macau business is just not as good as it used to be. But there's one stock that I am willing to endorse as a genuine China play, a nouveau China opportunity. And it's Ralph Lauren. To quote their last conference call from May, we are strongly encouraged by our continued brand momentum in China following the country's reopening. CEO Patrice Louvet, smart fella, says we drove full-year China sales up more than 20% in constant currency, including acceleration of fourth-quarter sales up 40%. Looking ahead, we expect China to remain one of our fastest-growing markets, end quote. There, finally, truth. Where do I come down on these? Look, I support buying Ralph Lauren as long as the American business holds up. I can see buying Starbucks as long as their cold brew sales continue to accelerate in the U.S. But the days when you could invest in these stocks purely based on China growth, those days are over. For years, they were the China plays until we learned our lesson that the Chinese economy just doesn't use enough oil to move the needle. And if it does, it's buying that oil at discount from Russia. That was the way we used to do it, right? Not from us. I don't think you're going to make any money, for instance, buying Occidental Petroleum or Exxon as China recovery plays. These things aren't working. So let me give you the bottom line. Go ahead. Knock yourself out imagining how China exposure can boost the growth of American companies. But I think you'd be better off finding a Chinese company that can accelerate its growth by being in America, because we are in much better shape than they are right now. Let's go to Bob in Vermont, please. Bob.
Hi, Jim.
Bob, what's going on, my friend?
Not much. Just raining here in the Green Mountains and waiting for it to stop.
All right, I hear you. Hey, listen, it's good for the garden. What's going on?
Around the first of the year, I bought an initial position in Devon Energy.
Right.
6 months in, I'm doing a little homework comparing it to like Emerson Electric, and it looks like we're slightly divergent. And I'm hoping it's more than just a short bad news story, and maybe you can help me understand that.
Yeah, sure. Well, Devon is, of course, it turns out to be uniquely levered to oil, and oil's been down big, so Devon stock's been down big. Emerson made an acquisition that really kind of screwed up their business for a while, but now that's past them, and I think that Emerson is actually the one to be in. My Chapel Trust owns it. I can't believe I'm going to be speaking positively about Emerson at our Wednesday meeting. Now, that will be a shocker that you must sign up and listen to. Bob in Florida. Bob.
Jimmy Chill, thanks for taking my call. How you doing?
Chill man came back from Iceland, real chilled. What's happening?
Oh, nice. It's a pleasure to talk to you. Hey, so I was in this local retail store recently, and I just, an article came out, 65% of its workforce is going automated by 2025. I mean, this store's packed, and I actually like using their self-checkout. Is Walmart a buy here?
Yes, I think Walmart is underrated. I think the business is good. I think the way they've been sourcing product is good. I like their grocery. I was surprised the stock only is still in the 150s. I think you have a winner. Why don't we own it for the just? Because we own Costco, their biggest and best competitor. I think in general you are better off finding a Chinese company that can accelerate its growth by being in America, because we're in much better shape than they are right now. Why don't people know that? On Mad Money tonight, we're starting to see some of the infrastructure bill spending make its way to a host of sectors. So what stocks could benefit from this new flow of money? I bet you don't know the names, so you better watch. Then last week, we got some important data on electric vehicle sales in the first half of the year. And I'm sharing the key points that I think can help you making some terrific investment opportunities for the remainder of 2023. And former SEC Chairman Jay Clayton and former CFTC Chairman Tim Massett published an op-ed in the Wall Street Journal this weekend offering guidance for the government to how to regulate crypto. And I'm learning more about the plan from Tim himself. You will love this interview, so stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.